Okay, hello everybody. Thank you very much for joining us. My name's Brian Parker. I'm the Chief Economist for Australian Retirement Trust, and really appreciate your time today. Now, today we're going to talk about something a little bit different. Mostly when you hear me speak about the state of the world and what we're doing with asset allocation and things like that. What we thought we'd do today is dig a little bit deeper into the way we think about the business of investing other people's money, and in particular, how we do manager research. We spent a lot of time as a fund focusing on selecting and retaining really well credentialed investment managers across the asset classes we invest in. And so we thought we'd actually do a bit of digging and actually talk a bit amongst ourselves about, what matters and what doesn't when it comes to the dark arts, as we're calling it, of manager research. So that's the theme of what we're going to talk about today. We're going to touch on the issues of, how you pick investment managers, how important or not is past performance. We're going to touch on issues of active versus passive. And we're really going to sort of dig and also talk a little bit about the kind of macroeconomic environment which actually makes happy hunting really for active managers. So that's essentially what we're trying to do today. Quick word from our sponsors. There you go. Now, when we're thinking about the investment managers, I'll just share with you some of the names that we use across the different asset classes. So, generally speaking, our preference is to not manage the money ourselves. We would rather spend the time. We certainly look after some money internally, but generally speaking, we seek to partner with the best external managers we can find, where we use our scale and use our access to negotiate the best fee deals we can. And if you can negotiate good deals and actually build a decent relationship with really high quality investment managers, we think that's pretty much the best way that we can invest members' money at this point. So these are some of the names that we use. Some of them will be familiar with you and some familiar to you, some of them won't. Arrow Street, for example, one of our international share managers, they're a quant shop. They're basically very pointy-headed propeller head types, very sort of active quantitative shop. Bailey Gifford, very well credentialed, well regarded growth manager in international shares. Maple Brown Abbott, well known to many on the call, a long standing Australian equity value manager. Platypus, a more growthy Australian equity manager. Partners Group, they're basically an alternative shop. We use them in particular for things like private equity internationally. That's one of our key private equity partners. And State Street Global Advisors, we would have in excess of $100 billion invested with State Street. In addition to them being our custodian, we also use them as our passive manager across all our listed asset classes. So we're able to, again, to use our scale to negotiate access and negotiate very low fees for passive management with State Street, as well as also they do also run some active strategies for us as well. So let me talk a bit about what we're really trying to look for when it comes to an active manager. Fundamentally, you're talking about the search for skill. You're fundamentally trying to find people who are genuinely good at what they do. And that's really hard to do when it comes to investing money. Now, let's go into some of the academic research on this. Now, Daniel Kahneman, who won the Nobel Prize in economics a few years ago, was talking about skill when it comes to investing. And, he came up with a really nice definition of skill, but also the kind of environment you need in order to be able to actually acquire skill. And he diagnosed skill as he said, basically, is the consistence of individual differences in achievement. And in order for that skill to be acquired, he said, you've got to have really two factors. You need an environment which is basically a high validity, or at least a fairly regular, predictable environment. And you've also got to be able to learn through practice. Now, unfortunately, financial markets really don't provide either of those things. And maybe the best analogy I can use is something like basketball or even cricket. So if you're Elise Perry or you're Pat Cummins and you're bowling in the nets, every day of your professional life, every day, every ball you bowl, the wicket is the same shape, this pitch is the same length. And you can just bowl a ball day after day, over after over. And every time you bowl a ball, the pitch and the wicket provides you immediate feedback. And you can gradually practice and practice, and you can develop a skill so that you know that if you practice enough, you can bowl a ball and hit middle and off very consistently. Or if you're a basketballer, if you're a Steph Curry from the Golden State Warriors, and you're on the 3-point line and the rim provides you feedback. You spend hours and hours in the gym throwing a basketball, and every time you throw the ball, the basket gives you immediate feedback. Needless to say, you don't get that kind of environment in financial markets. Now, it also, another question we sort of ask ourselves is, how important is it to actually identify skill? You know, are there genuinely good investment managers out there and people who are just frankly not so good? And what's the difference between being right and wrong? What's the difference between really good performance and very mediocre or even bad performance? And the answer to that question depends very much on the asset class. So what we've done here, this is some data we pinched off JP Morgan, borrowed, I think is a better term, but where they looked at the performance of US managers across a range of asset classes and looked at the difference over a 10-year period between, you know, the top quartile of managers and the bottom quartile. Basically said, okay, what sort of dispersion do you get in performance? Now, to the far left of the chart, if you're in global equities or in global bonds or in core real estate, the difference between being really good and not so good is somewhere between 1% and 2%. Now, that's meaningful, but it's not exactly really large. Whereas if you look at some of the more alternative asset classes, perhaps not surprisingly, given that these markets are a lot less efficient and a lot of the assets are far more idiosyncratic, and as are the strategies, you do get a lot more variation between people who are really good and people who are not so good. So classic example of this, I think, is the hedge fund space and in venture capital, obviously a core part of private equity investing. You know, in hedge funds, if you're really good, you're very good. You're doing double-digit returns over 10 years. But if you're no good, you're basically going nowhere over a decade and frankly wasting members' money. Similar in venture capital. If you are genuinely really, really good, yes, you're doing double-digit returns. You're doing 15, 20% per annum over a decade, which is a great result. But if you're not any good in this space, you really are destroying capital. So notice the thing, that wedge, the red wedge on the right there, that if you're a bad venture capital manager, then frankly, you really should just hand over the money to Vanguard and be done with it, because you really are destroying your client's capital. So in the alternative asset classes, there's a much, much greater difference between right and wrong than there is in the more traditional asset classes or the traditional markets. Now, that does, you might say, well, okay, that does beg the question about, you know, well, even if I do want to invest in these non-traditional asset classes, should I really bother trying to pick good managers? And frankly, one of the challenges we've got is that if you're a major super fund and you are invested in real estate and infrastructure and private equity and the like, which we do, if you want to be passive in that space, you can't. Because there is no easily replicable investment index that you can copy. So frankly, if you decide that you want to be in some of these asset classes, there is no substitute for doing manager research. There's no substitute for finding people who are good at picking particular assets to include in these portfolios, because passive is not really an option. Now, let me go talk a bit about manager selection in more detail, and I want to touch on what we call the manager selection merry-go-round. And I want to go back with a bit of history here. Some years ago, you know, before I sort of started working for super funds, you know, I'd have worked on the in investment manager land for Rothschild and Citi and the like. And one thing that I found in a previous home, we went through a period where performance was really, really struggling. We were very much value focused. And, you know, value strategies that underperformed. And we really were going through a period of underperformance for at least several years. Money went out the door. We really were very, very lucky to stay open at one point. However, things turn. You know, every dog has its day, as they say, and you know, performance did start to turn around. And I remember the head of equities at the time joking in saying, "Oh, look, it's okay, everybody, because money's about to start coming back in the door, because next week Mercer are going to publish their league tables, and we're going to be back in top quartile over 3 years. So happy days are here again." And it was a joke, because this idea that people would only actually pay attention to you if you had a good 3-year number was just way too naive to be credible. But sure enough, within a month of those league tables being published, we had consultants coming in through our door. We had prospective clients coming in through our door. And every time we said to them, hang on a minute, we haven't changed. We've got the same people, the same process, the same strategy, and yet all of a sudden we're attracting attention. And the bottom line for all of this was, look, there is simply no way we could have put you credibly in front of a client with the 3-year number that you had. Now you're a credible proposition. This idea that, I mean, this is ridiculous because at the end of the day, if you're going to hire people at the peak of their powers, inevitably you're going to go through another tough patch. So what are you going to do? You're going to sack them at the bottom of their performance cycle, and you're going to hire them back again after they recover. Investing money is about buying low and selling high, whereas when it comes to appointing investment managers, the temptation is by and large to do exactly the opposite. The definition of insanity is doing the same thing over and over again, expecting a different result. This pretty much comes to close to the definition of insanity in our view. So what it does suggest is that, okay, does past performance actually matter? And how much past performance do you actually need if you want to actually take it seriously? Now, one of the questions that came through, and thank you very, very much to those of you on the call that did submit questions beforehand. One of the questions that came through was about, oh, but you're probably going to say that you need years and years of returns to actually be statistically significant. And someone said, oh, but I've seen statistically significant results based on 2 years of performance. I frankly doubt that, because that sort of analysis is spurious at best. 2 years is not even a full economic cycle, let alone anything meaningful. So statistically, you do need a much, much bigger range of data. So it does, if you just think about the stats, and again, first year economic statistics was a nightmare for me, just quietly. I'm much better at telling stories and drawing pretty pictures. But if you ask yourself the question, if you want to look at the past performance of an investment manager and say, how many years of data do you need before you can be statistically confident that the excess returns they have delivered are not significantly different to zero? Okay, so those of you who remember T-tests and F-tests and all of those sort of things, that's effectively what I'm talking about. And the short answer is you need about 36 years at a bare minimum. But that's just the past performance data. Any statistician worth his or her salt will tell you that just looking at the past performance is not enough, because even then you might have chosen just a bit of dumb luck, and the model you've used might apply over that whole period, but maybe it only applies to bits of the period and not other bits. So what you also need to do is do an out of sample test. Use that projection based on your history and run it against an out of sample period. The out of sample period you need is about 27 years. You put it together, you're talking about 63 years of data in order to be statistically confident that your past performance is not significantly different to zero. Now, I don't know about you, but 63 years is a hell of a long time. It's certainly longer than my career to date. And by the time 63 years has passed, the investment manager you're assessing is busy sailing on his or her yacht somewhere. And personally, for me, after 63 years, I'll be drinking my own body weight in Chianti, frankly, in Tuscany, because and that's a lot of Chianti for those who know me. So frankly, past performance is not all that helpful, especially when you think about how there's a distinct lack of persistence in past performance. Now, what I've done here is look at some data from the Australian equity universe. So let's go back to 2017. And let's decide that we're going to build a multi-manager equity portfolio. And what we're going to do to make those manager decisions is we're going to look at the top quartile managers in the Australian equity universe based on their rolling 3-year numbers. Now, back in 2017, at the end of June, there were 32 managers in that survey who were ranked in the top quartile. Okay. Now, out of those 32 managers, how many of them, 3 years later, were still ranked in the top quartile? The answer is half of them were. The other half had dropped out. Okay. Now, scroll forward another 3 years. Out of the original 32, by the end in 2017, by the end of June 2023, how many of the original 32 were still ranked in the top quartile in that survey? The answer is 5. I'm sorry, that's not great odds if you're just relying on past performance. Now, and you get very, very similar results to this when you think about global equities, but also in fixed income as well. So past performance is not necessarily a great guide. Statistically, it takes too long, but also you don't get a lot of return persistence, at least not in the public markets. But what we found is that in a lot of the alternative strategies, and especially in private equity, the picture looks a bit different. And now this is a really ugly slide, but please bear with me, and I'll hopefully explain how to read it. What I'm trying to do here is try and assess whether past performance matters when it comes to picking managers in private equity, either in venture capital or in buyout funds. And so the way private equity tends to work is that, let's say I want to set up a private equity fund, and I basically assume that I'm really good at what I do. And I go and ring all my friends, or I go and visit lots of institutions. I put together a pitch book, and hopefully, if I'm convincing enough, I'll raise my first fund. And let's say I raise 500 million bucks or so, and I go out and invest that first fund. Right now, if my first fund does well, what are the chances of my second fund doing well? And this is what we're trying to ask. We're trying to ask whether just because you're good one fund, does it mean that your next fund's going to be any good? In other words, is there persistence in performance? So this is the way to read this chart. So let's look at venture capital, the left-hand box here, okay? So on the left-hand side is the ranking by quartile of my first fund, right? And on the top axis, or the top side of the box, is the ranking of my next fund. So in other words, if my first fund did well, what's the likelihood that my second fund also did well? And by well, I'm going to define well as at least second quartile. Now, this is where the picture gets interesting, because the top two boxes in there, the one that says 40% and the one to the right of that says 30%, what that tells you is that if my first fund is top quartile, then there's about a 70% chance that I'll be at least second quartile with my second fund. In other words, the odds are pretty good in my favor that if my first fund's good, so will my second one. It also works in reverse. The odds are that if I'm a dud, I'm going to stay a dud. The numbers also work similarly in buyout funds. So again, the top two boxes on the right-hand square, 43 and 27. So in other words, if my first buyout fund is top quartile, over 40% of the time, my second fund's also going to be top quartile. And if it's not, 27% of the time, I'll be second quartile anyway. So I'll still be doing better than median. So it suggests that, at least in private equity, there may be more to this past performance story, which begs the question, why? And part of it comes down to the idiosyncratic and very much relationship-driven, structure of these kind of markets. Let's say I'm a small startup company and I want to get funding, and I want to get funding from venture capital or from private equity. Who am I going to attract? Who am I going to go to? I'm going to try and actually go to the best performing funds, because that's going to be the only obvious filter I'm going to have. The bottom line is that if I'm a really good performing private equity fund, I'm more likely to attract the best potential startups. And if I attract the best potential startups, it also means my future performance is still going to be pretty good. So you do get a lot more persistence in performance because of the nature of private equity. Now, to be fair, some of the more recent data has not been quite as good, because private equity has certainly attracted lots and lots of interest and lots of managers into that space, like bees to a honeypot, and they can't all be that good. But nevertheless, there is at least still some persistence here. So past performance is some guide, but can you apply a purely quantitative approach to these things? Now, to us, manager research and selecting managers, yes, there's a scientific basis to it. You've got to do some quant, but there's a lot of art, there's a lot of relationship, there's a lot of trust issues as well involved in this. So this is where we're going to go to next. Now, again, one of the questions that came through was looking at some of the quantitative measures that someone asked, what are the top three measures? So I asked our public markets people in particular, and the fairly obvious ones, things like your information ratio, outperformance relative to the level of active risk you're taking, but also things like your hit rate, the rate, what percentage of your positions actually win versus, or your win-loss ratio, the active positions that pay off relative to the ones that don't, but also longer-term alpha, longer-term outperformance, not just 1 or 2 or 3 years, but 3, 5, 7, 10 years, and also how you've gone against various style metrics. So you might be a value manager that's been out of favor because style is out of favor, but can we compare you against perhaps a passive benchmark that is much more value-based to distinguish between, well, have you done better than most other value managers because you're showing some skill? The bottom line for us is there is no three individual measures. We look at a whole range of different measures to try and assess, whose performance really means something and whose doesn't. The other question that came through about how can you tell someone who's genuinely active and not just a benchmark hugger? That's relatively easy to do. You look at their active share. You look at not just their tracking error, how much they deviate from the index, but look at the sum total of their active bets, either overweight or underweight. Higher active shares imply lots more active management. Doesn't necessarily mean they'll get them all right, but it means that at least they're having a crack. At least they're actually trying to justify their fee by genuinely being active managers. So there is a range of quantitative tools that we use and a range of systems that we use, both internal and external, to make those calls. We have our own internal mechanism or internal process and model for picking investment managers. We call it Praxis. And what we're trying to do is look at a whole range of different variables to come up with how we rate investment managers. And some of them are quantitative, some of them are not. Some of them are very much very qualitative. So I just thought I'd share this with you to give you an idea of the breadth of indicators and measures that we use. Basically, we rank and by the way, we use this for manager research over all our asset classes, shares, bonds, and alternatives and private assets. Let's just touch on a few of these things. The organizational rating, just their business strength, their alignment with us, how aligned the team are with the business, the quality of the team, all very, very obvious. You might think that a lot of this is obvious, but it can very, very easily let you down. To give you an example, we came across a really, really good equity manager a few years back, and we thought these guys are really, really good. They genuinely had skill. They had a decent track record where they were before, and we thought these were really good. It was potentially a very, very good shop. But when we actually had a look at them and had a look at their business, it was kind of rubbish. It was still pretty amateur hour. Give you an example. We went into their office and the server that basically ran their business was sitting there out in the open against the wall underneath a fire sprinkler, which is not exactly a wonderful piece of risk management in anyone's language. So we kind of fixed that fairly quickly. We worked with them over many months to try and improve their middle and back office and improve their systems so that we brought them up to institutional quality. And once we were happy with that, we were happy to give them a mandate. However, we also found out within about 6 months that they weren't really properly aligned. That they sort of turned around and said, look, frankly, we really don't want your money because we can make more money by going retail. So they gave us the money back. So we weren't terribly happy about that. But what it tells you is that their interests were clearly not aligned with ours. And that certainly did stick in the craw with a lot of our research people. But alignment is really, really important. The strength of the business is important. Strategy. Does their investment strategy make sense? Do they have an investment philosophy that makes sense? Is it backed by decent academic research that their philosophy should actually work? Are they trying to pick anomalies in markets that are genuinely real? Is there a rational basis for their investment process? How do they construct portfolios? How do they implement? Do they have, an efficient way of trading and executing their portfolios? How do they measure risk? And in particular, the risk rating is particularly important. So on this, I mean, if things go well, how well could they go? Just how good can this manager be? But the flip side of that is if things go pear-shaped, just how pear-shaped could they go? And that's really, really important, especially when it comes to blending investment managers. Give you a guide, Bailey Gifford being a classic example. Those of you that might be familiar with the shop, very, very high octane, very well regarded, very active international growth manager. When they're good, they're really good. They have delivered very strong alpha for us over many, many years, very much like the manager. But probably about 5 or 6 years ago now, we took a bunch of money off them, even though their performance was really good. And we basically said to them, well, look, we're going to have to take some money off you. And they said, well, why? We said, well, because, yeah, your performance is brilliant, but we know that when you go through a really ordinary patch, you are going to really underperform badly, and you could potentially do so much damage to the overall portfolio that it could offset any other really good manager picks that we make. So we need to rebalance your impact on the portfolio. We don't, because you're so active in your strategy, we want to make sure that we're properly calibrating your exposure in our portfolio so that you don't blow us out of the water when things go bad. Now, that was a really, really powerful conversation, and they understood the rationale. Now, the good thing is that because of the relationship we had, we maintained that relationship, and now they actually manage more money for us than they did then because they knew that we were a growing fund, that they would end up ahead, and we would end up with a better balanced portfolio. ESG is crucial. We expect all our managers to embed ESG criteria in their investment decisions, as do we. The expected performance, also the fee structure. We like to think that we can use our scale to negotiate fees as low as possible. We also find that performance fees are very powerful. It certainly helps align the interests of our managers with our members and your clients. Often say, those of you that have investment managers coming in through your door every other day, you may remember that, there's always a good story. We find that, yes, there is a good story, otherwise they wouldn't be there. How convinced they are about that story can easily be judged by their willingness to accept a performance fee arrangement. So in other words, if the story is that good and you really are that confident in your ability, you'll of course agree to a very, very low base fee that'll keep your lights on. And if you deliver for our members, we'll write you a check. If you don't, we won't. I think that sort of alignment is also very, very powerful. And finally, and I've already touched on this already, the portfolio fit. Just because they're a great manager, it may not fit into your portfolio strategy, or at least you may not want to include as much of it as you like because they're too high octane, a la Bailey Gifford, for example. So how it fits into with the overall portfolio context is really, really important. Now, a lot of this boils down to trust. I have a rule to live by, which has never, ever once failed me. The person who is nice to you but rude to the waiter is an arsehole. That never fails. Trust is really important. And there's a great quote from David Swenson, who used to run the Yale Endowment Fund. And he talked about, the dinner table conversation. Don't invest with someone unless you're prepared to sit down and have dinner with them. And quite often, he would actually go in and look at how, if he found a really good investor, he'd go to the office and see how they interacted with their colleagues, see how they interacted with other clients, and quite often just see what they were like to sit at a dinner table out with them. He'd often ask his wife for advice about, well, what did you think of this person? Could you trust this person? Trust is so, so important. Because at the end of and it's one of the questions that came up in the pre-submitted questions was, how do you manage key man risk? Trust is part of it, but key man risk, there's two things that come into mind here. Yes, you might want to invest with a particular manager because this one person is so damn good, but if they fall under a bus, you've got nothing. So you need to look at succession planning, but also that's one of the beauties of having a multi-manager investment strategy, is that you're not going to be dependent. The performance of that manager may be very heavily dependent on one person, but you've got other managers in your stable that won't have the same sort of exposure. But yes, key man risk is something you do need to watch. You need to look at succession planning, look at just how, who is this person training to be the next generation of investors. We think that's important. Trust is crucial. Alignment is crucial. As I mentioned, that manager that basically terminated us, this tells you that our interests were simply not aligned. We like the idea of skin in the game. Does a manager have their own money invested alongside you in the same products that they're selling to you? We think that's important. And also from our perspective as well, we need someone who's going to grow with us. We don't want someone to turn around and say, no, we don't want your money anymore because you're too big. We need to be very, very conscious of how our alignment with the manager changes as we continue to grow, because we're now, a $310 billion fund. The other thing, I just want to touch on business structure again, and many of you, as I'm telling this story, might be able to think of some examples in the Australian universe about investment managers that have been through that. I mentioned that manager that we got in early and helped them set up. It didn't work out really well, but the theory wasn't a bad one. This is just a bit of a stylized life cycle of an investment manager. And it does beg the question, are you better off investing with a big, well-resourced, established, global, mega fund, or are you better investing with someone who's just starting up, who's a bit hungry, who's very, very dynamic and nimble, and is really passionate about their business? In other words, they're not kind of fat and happy, if you like. And so what I've done on this slide is basically look at the excess return potential. How good could they be in terms of their impact on performance versus the risk, the business risk you're taking by giving them money. And there is a bit of an inverse relationship here. So early on in the piece, early in the life cycle, they've got significant excess return potential, but the risk with investing with them is quite high because they're just starting out. So you've got to be very, very conscious of that. As they grow and get more resources and more experience, their return potential probably increases and the business risk goes down. So the dotted line is falling, the blue line is rising. But at some point, you get to the stage where business risk is bottomed out and you've basically started, I don't know what my light's gone off, excuse me, bear with me. But basically, your return potential starts to come down. There's an old saying, I think there was an article written in one of the journals a few years back called Elephants Can't Dance. And it was about managers just being too big and not being able to execute the way they want, especially if a small manager may be able to do more things in small and mid-cap space, whereas a big, large shop may find it hard to get set. They may take weeks to get a position in place. In the meantime, the market's moved against them. So here's the thing. Do you get to the stage where your return potential starts to decline, you start to get a bit fat and happy, and you basically, as a business, are dying slowly? Yeah, people might actually think that they're very safe by investing with you because you're a well-known name, but realistically, they're wasting their time because the best days of your business are behind you. One of two things can happen then. You can revitalize, you can reinvent yourself. That's the red line, and that's great, but that's a really, really hard strategy to pull off. So what's the answer? Do you stick to boutiques who are starting up or big global behemoths? The answer is it's horses for courses. You've just got to be ready, be aware of the limitations of both. Let's talk a bit about active versus passive. And I acknowledge that arguing about active versus passive is kind of like debating religion. And so there's not going to be an easy, satisfactory answer here. But one thing we have seen for much of the past, I'll say decade to decade and a half, is it's active managers generally have not covered themselves in glory. And so what you've seen is the rise and rise of passive management. So what I've done here, this is just a chart we stole looking at the value of equity funds in the United States. And so the total value of equity funds is in red. The light grey is the value of active funds and the dark line is the value of passive funds. In 2023, those two lines met for the first time. And a lot of it, I think, did reflect the underperformance of a lot of active managers and the cost advantages of going passive. And again, fully understand that given the fact that active managers did not cover themselves in glory. What's the solution here? For us, where we can use, where we can find active managers that based on all these criteria we've discussed in the last 20, 30 minutes, where we can find active managers that we believe have genuine skill, that we believe can outperform over time. And by that, I mean outperform by a multiple of the fee we pay them. Then we're happy to use them. Where we can't find them and where we can use a passive alternative and save the money, we will. So it's about choosing active managers where they offer value for money and passive where they do not. There are some asset classes where it works better than others. Clearly, in the private asset space, you almost inevitably have to be active because you can't be passive in that space if you want to be in those asset classes. And I would argue, given the return potential, you do want to be in those asset classes. But certainly, I think when it comes, I think everyone on this call is going to have a different answer to this question. For us, the answer is both. So, for example, in listed markets, we use both active and passive. In our private assets, we are by necessity active, given the idiosyncrasies of those markets. The other thing I wanted to finish on was a discussion about when active managers should thrive. What's the ideal environment for an active manager? And so I'm going to talk quant here, but I'm also going to touch on macro, which again is a bit more like my home turf. The fundamental rule of active management. What's the excess return a manager should deliver? It's a function of their skill. Are they any good? Secondly, breadth. What's the opportunity set they've got? Do they have lots of opportunities to demonstrate that skill? And finally, efficiency. Can they utilize that skill and do it in a very, very low cost or at least cost effective way? If you've got skill and lots of opportunity and you're very low cost, you should be able to shoot the lights out. That is the theory, but it's easier said than done. Two more charts on this pack. One, this is again looking at the environment over the last few years, and I'm talking here about volatility. This is two measures of volatility. So the blue line is the rolling 18-month volatility in global share markets. So it's just the volatility in returns of the MSCI Investable Markets Index. Okay, so it's a very cyclical beast. You go through periods where the market is very volatile and periods where the market has relatively low levels of volatility. Okay, but the red line is maybe a little more interesting and also a tiny bit harder to explain. It's the rolling 18-month cross-sectional volatility. So it's looking at the thousands of companies that make up the Investable Markets Index and looks at the dispersion of returns between those companies. To what extent are there clear winners and losers over any given time period? Now, in theory, if you have volatile markets and if you have high levels of cross-sectional volatility, that would suggest that the breadth of opportunity for active management is wider. So active managers should cover themselves in at least some glory if they have genuine skill. And this is a very cyclical beast. Have a look at the period from about just after the GFC, so around 2009, 2010, through to COVID, through to about June 2020. So all this period here in the middle, or towards the right. That period generally was a period where cross-sectional volatility was mostly fairly low. Okay, I think this goes at least part of the way, or a large part of the way, to explaining why active managers in equities perhaps didn't cover themselves in as much glory. Okay, now what have we seen more recently? We've seen that pick up a bit. You've actually seen volatility rise in the post-COVID period. You've also seen a bit of an uplift in cross-sectional volatility, although in recent months it has come down again. But this is clearly a fairly volatile beast. There will be inevitably periods where passive managers are going to really be the way to go. There'll be other periods where active managers are going to be the way to go. I think it's a common sense approach to it, maybe to at least consider using both. That's kind of where we've landed generally in the share portfolios we run. The other thing is the macro environment. Now, I would argue that for much of the period since the GFC, exacerbated by COVID, you generally had a period where interest rates were very, very low, if anything close to zero for a lot of that period. And not only that, you had quantitative easing. You had lots and lots of central banks, or the major central banks of the world, buying financial assets and injecting liquidity into the financial system. And when you have an environment of abundant liquidity, a rising tide tends to lift all boats. And you see this in superannuation fund returns as well. If those of you familiar with the APRA performance test may remember that, even super funds that failed the performance test still managed to deliver reasonably okay returns. In fact, in most cases, probably delivered returns that were better than their long-term benchmark. And that's perhaps suggesting that, it was the environment where even if you're a dud investor, you might not have looked like a dud investor because, frankly, the rising tide lifted all boats. Those days, I think, have clearly come to a bit of an end. So on the left-hand chart here, this just shows you the direction of that quantitative easing. It's now becoming quantitative tightening. This shows you the money base, or the liability side of the central bank's balance sheet. As a percentage of GDP in the major economies plus Australia. It shows the average for pre-COVID, what happened during COVID, what the latest data are showing. And what it's showing you is that quantitative easing is being slowly unwound. The tide is slowly going out. Okay. We've also seen in recent years interest rates normalize. Now, yes, they've started to come down again, but I think we're going into a period where economic and market conditions are perhaps going to be vastly different to the environment we saw for much of the post-GFC period. In other words, liquidity will not be as abundant, interest rates will be more normal and perhaps more volatile, and markets and cross-sectional volatility will be perhaps a bit more volatile. I would argue that there's a fair case to be made for not giving up on active management, particularly in equities, if you can engage with people that have genuine skill. Now, that was a fairly long-winded presentation. I'm happy to take any further questions, but hopefully I've addressed a lot of the sort of pre-submitted questions. And again, thank you to those that did submit questions. And I hope you've given, and again, there's no right or wrong answers here, but I hope that I've given you some food for thought and given you some things to take away and think about when it comes to the managers that you select on the different platforms you use for your clients. And with that, I think I've got some questions that have come through. Let me just go through some of them, I think. What percentage of funds are invested in index funds as you appear to do a course? We have in our share portfolios, think roughly about half. We go about half is in passive, give or take. Another chunk is in active quant. So in other words, very, very low fee managers that are very quantitative, where they're trying to add a bit of incremental value over time. Arrow Street is one of those managers in international shares, and the rest, the top of the pyramid, if you like, is fully active. Well, we basically expect these guys to be managing, managing idiosyncratic portfolios, highly benchmark unaware. Bailey Gifford being perhaps most extreme example of that. And what fee for alpha? It depends very much on the asset class. So, for things like equities, we would want probably at least double. Double the base fee. And again, our base fees tend to be very, very low. And it also partly depends on the tracking error or the, just how high octane a manager is. So, if we've got a manager who on a, a priori basis, we expect to deliver significant alpha, well, we're going to hit them with a higher fee for alpha criteria than we would someone who's going to be, trying to add just an incremental value over time. Let me go through the yeah, the information ratio is a good way of just looking at skill. It's basically looking at, okay, the denominator is tracking error. So what percentage of so if I've got a tracking error of 1, it means 2/3 of the time my performance is going to be plus or minus 1% around the benchmark, right? If my information ratio is the excess return or above or below benchmark divided by that tracking error. So it's basically looking at how well rewarded I am for the index deviation that I'm taking, basically. Generally speaking, if you've got a manager that's doing 0.4, 0.5 as an information ratio, it's not bad. In fact, it's pretty good. Can you speak to style indices, particular style indices that mean a great many things? Yeah, sorry about that. So there's a range of style indices around out there. So if I think about the two main, so value and growth. So the index providers, if you want to be very naive about it, you just look at price to book value. So in other words, some of the more naive strategies, indices just say those stocks that are relatively high price to book value are growth, low price to book value are value. That's probably too naive. And certainly growth managers would tell you, well, hang on, we don't just buy high price to book value stocks. So the better indices look at a range of different factors which are typically associated with growth, high historic earnings growth, high returns on equity, as well as a valuation measure, but they'll look at better, more rigorous measures of growth. So those companies that are trading at, lower PE multiples, price to book value multiples, have somewhat lower returns on equity, will tend to be classed in the value bucket. So that's what I mean by style. Now, would you? Now, the other question, would you agree there is no genuine test of skill, that when you refer to a fund manager's skill, that it's actually an opinion? Oh, it's a good question, because it is, this is why so much of it comes down to art and science, right? Is that you can do all the quant work you like, but a lot of the qualitative work is every bit as opinion. Every bit is significant. And again, when I think about the guys that we employ who do manager research, will they disagree? Absolutely they will. So it's about, looking at a whole range of indicators looking at a whole range of variables, and really, engaging with the manager over an extended period of time. By that I mean several years, not several weeks or months, and coming to a view as to whether they fit into the portfolio or not. And where you can't find managers, yep, you happily to use a passive alternative. Um, What's your take on passive at the core, active as a satellite? Perfectly defendable strategy, particularly, if you've got some managers who you really like to use, but you're also conscious that, some of its clients are particularly fee sensitive. Yep, having a significant allocation to passive is perfectly reasonable. Any other question? I'm just trying to think if there's any other questions. I think we're good. Shall we call it quits at that point? Bear with me. I think we shall. Look, ladies and gentlemen, thank you again for your time. Apologies about the technology interruption, but thanks so much for dialing in. Hope we've given you some food for thought. Look forward to catching up with many of you on the road over the coming months. All the very, very best for the remainder of 2024. Cheers all.